and got as far as just doing some basic journal entries for notes payable, long-term notes, short-term notes actually, current liabilities we've been talking about. So basically the short-term notes credit lines, we discussed all that. And we learned how to calculate interest and to do the journal entries for both interest and non-interest bearing notes. So that's as far as we got. So today we're just going to continue. I'll spend this week in chapter 13 and that'll be it for chapter 13. Now obviously we've got a break coming up, so when we come back we start chapter 14. I want to save a few minutes at the end of class today to give you back your exams. So if somebody remind me at like 12:05 if I'm still yapping away. I know you guys don't like to remind me, but please do. I'm trying to pay attention, but you know. Okay, so keep in mind now our focus has shifted from assets, right, on the left side of the accounting equation, and we've moved to the right side of the accounting equation where we're focusing on the credits, right, normal balances of credits. And so up to this point, you know, we haven't gotten too far into this, but a lot of what we cover in chapter 13 is review. We may go into a little bit more depth with some of these topics, but you are for the most part introduced to these topics in Accounting 101. So since we're continuing, you know, talking about liabilities and loans, let's talk about what a secured loan is. These next few slides are just kind of reviewing some information. We talked about briefly in Accounting 101, we didn't get into great detail, and we actually looked at this when we talked about accounts receivable. So we're kind of looking at this as the other side now, but we can sell off our accounts receivable, right? They're assets. Most of you will probably have the same experience that I did and most other people do if you have a student loan. You go to a financial institution and you borrow money, and you graduate and you start paying back your student loan 6 months later, and a few months into your loan repayment, you get a notification that your loan's been sold. Don't get too excited, you still have to pay it back. You just now write your check to someone different than the institution that you originally borrowed the money from. And why do companies do that, or why do financial institutions do that? Because they want to unload the things that really don't generate a lot of income for them, but kind of generate a lot of expense. So you're paying somebody to monitor these student loans and deal with non-payment and all that good stuff. So a lot of companies will just sell off the student loans because they can make more interest with something else, with other types of loans, right? Pledging accounts receivable, you use your accounts receivable as collateral. So you borrow money, you say I'm going to set aside or establish this X amount of dollars of accounts receivable as collateral for the loan. And oftentimes when you receive the payment from those receivables, you use the payment to pay back the loan. So there's a lot of different types of arrangements that can kind of come from this. So this is just information, I'm not showing any journal entries associated with this. If this is the situation, you'll see information, the details about the arrangement in the notes to the financial statements. And hopefully, well, like with chapter 12, I know CVS was the company that we used to answer the questions up to this point. We've been using Target, but hopefully you're getting comfortable with the financial statements, the 10K, and then the notes, which provide additional information. So a lot of times, what you're looking for, you kind of got to dig for. But yeah, anyway, so just another type of loan arrangement here. And then commercial paper, we talked a little bit about that, but some more details here about commercial paper. So remember, I kind of likened it to borrowing money from your parents rather than going to the bank and borrowing money. You don't have to fill out all kinds of paperwork if you're borrowing money from your parents, hopefully. I don't know, maybe they will draft up a document of some sort. And you probably, if they're going to charge you any interest, they're going to charge you less interest than what you would be charged if you went to the bank and borrowed the money. So when you have parent subsidiary companies, this is very common, related entities borrowing money from one another. And typically commercial paper is sold in denominations of $25,000. So that's a nice round number, and it's unsecured, which we discussed the difference between secured versus unsecured. The maturities range from 1 to 270 days. So these are short term, right? So basically 9 months or less, 9 months or less. And oftentimes these are loans to kind of help one company just get through, you know, a kind of a rough patch. In other words, a period of time where maybe cash flows, you're struggling with cash flow, right? Anything beyond 270 days would require a company to file paperwork with the Securities and Exchange Commission, something everybody would like to avoid if possible. So that's why we kind of keep those to 9 months or less. With these, this is usually a discounted note, so interest is usually taken off at the beginning. Commercial paper is often backed by a line of credit. We talked about what lines of credit are. So you find a financial institution that's willing to loan you X number of dollars, and instead of having to go through the process every time you need to borrow money, this money kind of just, an amount of money available to you kind of sits out there, and you can borrow from it as you need up to a certain point. You borrow, let's say if you have a $75,000 line of credit, you borrow $30,000, pay back $30,000 plus whatever interest you were quoted at the time that you made the arrangements. And you can borrow up to the 75. And again, the whole point of this is that your interest is going to typically be lower than it would be if you were to go to the bank and borrow money. So some examples of disclosures here. Again, pretty straightforward. We've got one for short term and one for commercial paper. Comcast there for commercial paper. And it just talks about how many, what the total amount is for that 9.2 billion. Always like to throw those in there. Okay, moving on. So accrued liabilities. You guys have covered this before as well, so this is definitely a review. Particularly Chapter 3 in Accounting 101, when you were introduced to adjusting entries. And accrued, the word accrued means incurred but not yet paid, right? And so accrued expenses and accrued liabilities go together. You are probably most familiar with interest. So when you've incurred interest but you don't have to pay the interest yet, you debit interest expense and credit interest payable. Another great example are salaries, salaries expense, salaries payable. And these are recorded through adjusting entries, and we're going to practice one here. Usually these are combined, so all of your accrued liabilities are usually combined together and reported as one amount, a single amount on the balance sheet. And then you've got to go to the notes to the financial statements to find the details. I gave you two examples. The third would be income taxes payable. So let's take a look at an example of a note with accrued interest, because this is pretty common, so I want to make sure you guys can do this, and then we'll do a brief exercise to practice. Okay, so when is it necessary for us to accrue interest? Well, that depends on a couple of things. It depends on the term of the note. It also depends on how frequently you're required to pay interest, and also when your fiscal year ends. Okay, so this one says on May 1st, Affiliated Technologies, Inc. borrowed $700,000 cash from First Bank Corp. Under a non-committed short-term line of credit arrangement and issued a 6-month 12% promissory note. That should sound familiar to you. We've had the same variables and examples before, even in a previous chapter. Interest was payable at maturity. Assume the fiscal period for Affiliated ends on June 30th. So I know we want to always think December 31st, but remember, not every company's fiscal year ends on or aligns with a calendar year. So this one is particularly June 30th, 2 months after the 6-month note is issued. So I like, you know, if you struggle to understand how this works, right? You know, you can draw yourself a little timeline here. And, you know, at this point, we've got the end of year, right? End of the fiscal year. And then somewhere over here, you've got the due date of the note, right? And so if the end of the fiscal year comes between the inception of the note and the due date of the note, this right here, this is what makes us have an adjusting entry, right? Because what I have here, this is June 30, is I have now 2 months, right? 2 months. 2 months worth of interest that belongs in 1 year, and let's say it's 2025, right? And then the other amount of interest belongs in 2026. So you've got to split your interest expense over 2 years, right? Because what happens is you've got this end of the year kind of interfering, right? And so if we do the math, and this one's pretty straightforward, what's our formula for calculating interest? Interest equals what? Yeah, PRT if you want to make it short, right? Principal times rate times time. And the time factor, this piece right here, right? Time factor is what is necessary if we are calculating interest for a period of less than how many months? 12. Because most interest rates are presented as what? Annual percentages, right? Now, do you want to pay 12 months worth of interest if you only have the use of the funds for 6 months? No, of course not, right? All right, so we don't need to do all the extra work here. It's done for us. So let's take a look here. Well, so we got 2 journal entries. One is the issuance of the note. So you're borrowing. It says borrowed cash. And remember, you ask yourself, you're like, well, which side am I on here? We are focusing on liabilities. So we're the ones receiving the cash and having to pay back the money later. So very simply, a debit to cash and a credit to notes payable. We don't pay back the note for 6 months, right? And so if June 30, so June, July, August, September, October, right? We don't have to pay back the note till October 1st. Well, November 1st, I guess. July, August, September, October. Yeah, November 1, right, is going to be the due date here, depending on how you're counting days. Now, if you're counting using 365, it's going to be different than if you're using 360. Textbooks vary. They differ on that. Banks differ on that. Not a big deal. You just have to pay attention to the textbook and the problem. Okay, but anyway, what we're interested in is we're interested in the accrued interest as of June 30. And so there's our formula, principal of $700,000, right? Times the rate, annual rate of 12%, times 2 over 12. The amount of accrued interest as of June 30 is 2 months worth, right? So that translates to $14,000. So the $14,000 of expense belongs in 2025, even though the $14,000 plus the rest of the interest expense isn't getting paid until 2026. Make sense? So then when you go to pay back the note, you'll have the satisfaction of the payable for the interest, an additional 4 months worth of interest, right? And then the repayment of the note. So let's see that. And here we go. So now, because if you look at it this way, you've got 700,000 times 12% times 6 over 12. This is the total amount of interest, right? So what does that come out to be? That's 42,000, right? You guys remember that from before? This is a number we've seen before, right? The problem is that I got to split this up, right? 2 months of it belong in 2025 and 4 months belong in 2026, and that's essentially what we did. So the 14,000, right? 2 months worth belonged in 1 year. The other 28,000 of interest expense belongs in the next year. So here's the debit to interest expense for the other 4 months of interest. So 700,000 times 12% times 4 over 12, okay? And that's what we did, right? The 6 months is the total, the 2 plus the 4. That's what I did here. You can then break it down. You can do it that way if you want, and then break it down. Break the 42,000 down 2 versus 4 months if you want to do it that way. And then the interest payable, because you, on June 30, you credited interest payable, and now you're satisfying that liability. You're going to debit the notes payable account because you're paying off the principal, and then your credit to cash is for the total amount. Pretty straightforward, I think. Questions? Okay, well, take a look here. This is page 745, brief exercise 3. before we move on, let's make sure we master this and how to go from there. Oh, 745 is the page. Okay. It says, on July 1st, Orcus Lab issued $100,000, 12% 8-month note. Interest is payable at maturity. What is the amount of interest expense that should be recorded in a year-end adjusting entry if the fiscal year is December 31st first? Let's do that one. There's A and a B here, okay? So assuming that the fiscal year, excuse me, that the fiscal year ends December 31st, that's part A. And all exercise 3 is looking for are 2 simple journal entries. Actually, I don't even think they asked for the journal entries, just asked for the amount of the entry, or the amount of the entry, but we're going to do the journal entry. So I'm looking for the amount that I need to debit interest expense and credit interest payable. If I assume that the fiscal year ends December 31st for money that was borrowed on July 1st. Fair? All right, so all I got to do is calculate interest here, right? PRT. What's the principal? What's the annual rate? And how many months of interest do I need to record if the fiscal year ends December 31st and the money was borrowed on July 1st? 6, yeah. Because July 1 is all of July, right? All of August, all of September, all of October, all of November, December 31st, all of December. No shame in using your fingers to count months, okay? No shame. So what do you get? 6,000. This is an 8-month note, right? And so 2 more months would have to pass. Those other 2 months of interest would get recorded in the next year, right? Along with the satisfaction of the interest payable and the repayment of the note. Fair? You guys with me? Now that was pretty simple, straightforward. You weren't asked to do all the transactions that went along with that. That's okay. What if it goes on to say part B? What if the fiscal year ends September 30? Okay. Same journal entry, right? I'm still accruing interest. But now, how many months of interest gets recorded as accrued? So what I'm changing here is this goes from 6/12 to 3/12, right? All of July, all of September, all of October. And so, you know, if 6 months is 6,000, 3 months is 3,000. And then the other 5 months worth of interest gets recorded in the next fiscal year. All of the interest gets paid in the next fiscal year, right? But the expense has to get split up over the 2 years. Does everybody understand what I mean by that? The expense getting split over the 2 years? Okay. And what makes interest accruable? I don't even know if that's a word. What happens? What has to happen before I can record interest as an expense? Time has to pass. Yep. The length of time that you have the use of the funds is what dictates your interest expense. Questions? I was gonna have you guys do brief exercise 4, but I'm gonna just make a comment. And here's what, so, because I kind of switched it up and I know it's not highlighted, but we did brief exercise 13.2 last week. And then that's where we stopped, obviously. Commercial paper, the brief exercise 3.4, you record it exactly the same way as you record the non-interest bearing note. And nothing is going to change. So I had you guys do brief exercise 2. I'm not going to have you do brief exercise 4, but I'm just letting you know that a commercial paper is recorded in the same manner as a non-interest bearing note. Typically, that's what they are. How do I know that? If you read brief exercise 4, it says, Wang Corporation issued $12 million commercial paper. That's a loan. Just means a loan between entities. It says it was discounted at 9%. So if something is discounted, that simply means that the interest is deducted at the beginning of the note. And that's exactly what we did with brief exercise 13.2. So the process there is exactly the same. Okay, any questions with the accrued interest? All right. Jumping right back into it, moving on. Salaries, sales commissions, bonuses. These all tend to be accrued liabilities. Now, let's talk about why. Like list these here. How do you typically earn vacation time or sick time, and what does that even mean? You accrue, and some of you probably have had jobs where you maybe and maybe not, because maybe you haven't had a job yet where you're accruing any kind of sick time or vacation time. But what does that mean, and what's your benefit based on typically?
How long I work.
How long you work, right? So normally after working so many weeks, hours, months, whatever the policy is, you start to earn time off in the future, right? So what has to happen, and this can get a little tricky, because what companies will have to do is that, like, at the end of a fiscal year, they'll have to estimate how much accrued time off each employee has earned based on time that they previously worked, right? Sometimes you take the time off, sometimes you may have the option of, carrying it over or just getting paid for it, that kind of a thing. So there's a lot of, like, I'll use the word uncertainty, but there is some uncertainty with these kinds of things. Maybe not so much with, your actual salary, commissions, bonuses, but vacation time, sick time, paid future absences, because what can be uncertain is when you take those future absences. Now, your employer probably gives you some kind of criteria that you have to follow, right? You need to use this up by X date, or you can carry over, 2 of your 5 days, or whatever the policy is. There's a lot of things that can kind of impact that. So there have to be 4 conditions for accrual of paid future absences, which means, for example, like at December 31st, if that's my end of my fiscal year, I have to evaluate all of my employees, and I have to determine which of them have earned future time off. I'm not paying them for it yet, but it is already, for example, on December 31st, it's a salaries expense, because I have to record it in the year in which it was incurred, the expense was incurred. And as soon as you earn it, I owe it to you. So it's incurred in that period of time, even though I'm probably not going to pay you for it till next year or whenever, right? So it's still this simple journal entry for the most part, with some variations depending on what it is. It could be vacation pay, if you break it down that way. It varies across companies, but it says the obligation is attributable to employees' service already performed, which I've already said a few times, right? The absence can be taken in a later year, right? The benefit vests, or the benefits can be accumulated over time. What's vesting? You guys are going to hear that term once you get jobs and you're signing up for retirement plans. What does it mean to be vested? Does anybody know? Really? No one knows? Okay. I think you talked about this maybe in like a finance class or something. Okay, so let's say you get a job, right? And you have to work at that job for 1 year, and then you're entitled to participate in the company's 401k, which is a retirement plan, right? You start contributing to the 401k. The policy at your work is that you are not fully vested until you work there 5 years. So after each year, you're vested 20% more. So 20% after year 1, 40% after year 2, 60, 80, 100. Okay? Some places it's 100% vested after 2 years of working there. All that means is this. So if I start working someplace and I'm allowed to contribute to my 401k immediately, I start putting money in. If my employer matches my contribution, right, I'm entitled to only a percentage of that contribution unless I'm fully vested. So let's just say that I work somewhere, I'm vested 20% and I leave, I quit. I go to find a job somewhere else. When I leave, I take my contributions of my 401k with me, 100% of my own, but I only get 20% of what my employer had given me because I'm not fully vested. If I am fully vested and I leave, I take 100% of mine and 100% of what my employer gave me. So there's 2 common vesting periods, 5 years, so it's like 20% each year, and then 2 years. So like it varies, right? What do they do with the other? Let's say that I work somewhere a year, I'm only vested 20%. Remember, I always get to take what I put in. They're not keeping my money, right? So what I put in, I take regardless of how long I work there, right? But I was only vested for a year, so I only got to keep 20% of the employer contributions. What do you think they do with the other 80%? What do you think the employer does? Okay, so there's one option is they take it back, right? Put it back in their pocket. No, they don't do that. But I don't get it. Who gets it? You have any idea? The other employees. It's called a forfeiture. So, and I've seen them on my statements. I don't know if people pay attention too much, but you know, we teach this stuff, we pay attention. So if you ever see, when you guys get jobs and you ever see forfeitures, that's what it means. It means that another employee was not fully vested and their part of the contribution that their employer made to their 401k was forfeited and distributed to everybody else who remained working at the company. Okay? That's just a little sidebar there. Anyway, payment is probable. You're likely to get paid, obviously, and the amount can be reasonably estimated. It's typically, obviously, based on your current salary, so those things are kind of easy, nothing to be too concerned about there. Here's an example. I don't really get into this too much with journal entries, but I do like to show you an example. So we have Davidson Getty Chemicals has 8,000 employees. Each employee earns 2 weeks paid vacation per year. Vacation time not taken in the year earned can be carried over to subsequent years. Listen, if it wasn't allowed to be carried over, what would happen on December 31st? What do you think? If you didn't take your vacation and you couldn't carry it over? It gets paid out. This would just be cash. You just get paid, okay? During 2024, 2,500 employees took both weeks vacation. But at the end of the year, 5,500 employees had vacation time carryovers as follows. So you're gonna have some people that take their vacation, some people save it, right? So here you have 2,500 employees whose vacation weeks earned but not taken, 0, so no carryover. You've got 2,000 that had 1, so total carryover is 2,000, and then you had 3,500 employees that had 2 weeks earned but not taken, so total carryover is 7,000, right? So based on that information, and then we have to know how much they make. Yeah, sorry, there we go. During 2024, compensation averaged $600 a week per employee. Now, keep in mind, you'd have to keep, this is for the purposes of this entry because it's like a summary entry, but your employer would be keeping track of individual employees and making entries based on individual employees' payments, or payroll amounts, right? Salaries and wages. Okay, so here we have when vacations were taken. So you had 2,500 employees that took their 2 weeks at $600 a week, right? Plus then you had 2,000 employees that took 1 week of vacation at $600 a week. You do all the fancy math there in the middle, not really fancy math, but your salaries, expenses, $4.2 million, and then either cash or salaries payable depending on when payroll fell. That obviously would matter when payroll fell. The carryover, the carry forward, is going to be an adjusting entry. And you'll notice, you know, I had debit salary expense, salaries payable. To separate these types of payments, these future absences, they're using an account, it's still a liability account, it just has a different name than salaries payable, right? So it's still a debit to salaries expense, a credit to an account called liability compensated future absences. And the calculation you had 9,000 carryover weeks, that's $600 a week, and there's your number there. And again, I won't have you guys do this, but, and then let's make an assumption here. In 2025, the average pay went up. Okay, so now these are when folks are actually taking their vacation, okay? And so you got a little bit of a difference in pay, which you have to account for that too. And so like I said a couple minutes ago, this can get a little bit complicated. So you're gonna clear out the liability, you're gonna make up for the difference in the salary expense between the former pay and the current pay, and then the credit is to cash or salaries payable, depending on when you're making those payments. All right, I won't have you guys do that, just wanted to show that to you. The same pretty much applies with the annual bonuses. Annual bonuses are typically payments that are tied to some kind of performance objectives that have been met, right? And really we do it to incentivize people to work harder, right? And basically also same idea, compensation is accrued when it's earned, right? And again, this is just examples of, you know, and maybe, again, I don't know if any of you have any experience with getting a bonus based on performance. Sometimes it's based on the company's performance overall, and some of those different measurements can be earnings per share, net income, operating income, non-financial measures, customer satisfaction, product or service quality. Those are just some examples there. Okay, any questions on vacations or accrued time, anything like that? Okay, yeah. All right, so liabilities from advanced collections. You guys have done these before, but we're gonna actually review some of these because these are pretty important, and we'll probably do a couple of exercises here with regards to these. So liabilities from advanced collections. I go back to Accounting 101, and I go back to my lawn care business, where I always explain unearned revenue this way. If I cut your grass every week and you're going on vacation next week and you ask me to cut your grass while you're gone and you give me $50 today, can I call that $50 revenue? Why not? Because I haven't done the service yet, right? I owe you something, don't I? What do I owe you? Service cut your grass. So until I cut your grass, I have to record that $50 as a liability, right? You guys remember that? So yes, I can debit my cash account because I got $50, but my credit does not go to revenue. My credit goes to unearned revenue, which is a liability. As soon as I cut your grass, I move the money out of unearned revenue and I put it into a revenue account, right? So any kind of advance payment is a liability. The receipt of any kind of advance payment. What we mean by advance is in advance of actually providing the product or the service. So if you pay me for a product and I didn't deliver it to you yet, I can't call that revenue. I owe you something. Remember, think about the chapter title. This is about liability, right? Not revenue. So our initial journal entries should always be a liability account. Okay. So refundable deposits. Have you ever put a deposit down and they said you get it back once you return something? Or it's like the garbage cans now that they use for the trash pickup and the recycle bins. You have to put some kind of deposit down on those, and then if you ever move or get a different service, they'll give you back your deposit. Sure they will later on, right? Depends. Gift cards. Aren't you really paying in advance for a product or a service that somebody hasn't actually received yet when you buy somebody a gift card? Yeah, right? And then collections for third parties, because there are financial institutions that are going to act as collection agents for companies. So this is a very common one, so let's take a look at this one first. Excuse me. All right, so Rancor Chemicals sells combustible chemicals in expensive reusable containers. Customers are charged a deposit for each container delivered and receive a refund when the container is returned. Deposits collected on containers delivered during the year were $300,000. So the company should really say what to itself? Like, this is not money I should spend, right? What's the purpose of collecting a deposit? Security. Like, what if you jack up my container and I got to buy a new one, right? I don't want to incur the expense. I'm going to make you pay for it, right? Okay, it says, blah, 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 where am I at? Okay, deposits collected with $300,000. Deposits are forfeited if containers are not returned within 1 year. So if you don't return your container, they keep your money. That's pretty common too. 90% of the containers were returned within the allotted time. Do you think 100% of customers are going to return their containers? No. No. Deposits charged are twice the actual cost of containers. So why am I charging you twice the amount of a container? Because I can. Charge whatever I want, right? Sure. The inventory of containers remains on the company books until deposits are forfeited. All right, so let's see what we got here. Okay, deposits are collected. Pretty straightforward. You debit cash because that's what you received. You credit a liability account. Yeah, again, guys, chapter 13, all about liabilities. Every initial journal entry you make should be a credit to some liability account. That's the title of the chapter. So we'll call it liability refundable deposits. The names of these accounts can vary, so there's nothing special about the name. Okay, now, the problem says that 90% are going to be returned. So what does that mean as far as the cash I just received? 90% of that I'm giving back, right? So in the next slide, containers returned, 90% of the 300,000 is going to be sent back. So of the 300,000 I collected, 90% of that's 270. Now I'm sending back my customers $270,000, reducing the liability by the same amount. How much is in my liability account right now, though, at this point? 30,000, right? The accounts are helpful. I'm abbreviating here, by the way. Okay, so when we collected, right? And now you'll see that's debited. We returned. So we got a balance here that we got to think about. Okay. If customers don't return the container in a year, do I owe them the 30,000 back? No. Isn't that what this said? Deposits are forfeited. Guess what? I get to keep your money. So that 30,000 is no longer a liability. What do you think it is for me now? It's going to be revenue. I treat it kind of like a sale, right? So look, when the deposits are forfeited, I got to get this amount out of here. I don't owe it to anybody now, right? The 1 year's passed. It's now revenue to me. So I will debit the liability account for 30, and I will credit revenue. I treat it like a sale. Guess what? You bought it. You never brought it back to me, so you bought it. Does that make sense? That container is sitting in my inventory because I owned it. Now, if I treat it like a sale, you guys know anytime we sell inventory, we have to remove the item from inventory and record our expense. So there's the debit to cost of goods sold and the credit to inventory. And why is the inventory only worth half of the deposit that is now revenue to me? Yep, charge the container, right? I charge twice as much. Don't I want to make some money just like I would want to make some money if I'm just selling my typical inventory? Same idea. All right, questions? You guys are ho-hum today. Okay. Some more examples here of advances. So, gift certificates. Magazine subscriptions, do people really lay away things still? I don't know, maybe. Special orders, usually when you place a special order, right, you've got to put half down oftentimes. And again, that's just so if you never pick up the item, that the person who placed the order is probably, you know, it was maybe a customizable thing. Who else is going to want it, right? They're not out all their money. Airline tickets, right? Because you pay for those in advance too. And the airline can't call that revenue until when? Till you fly. Absolutely. Okay. So let's take a look at a couple examples here, and then I'll give you guys some practice here, and then we'll call it a day. All right, so Tomorrow Publications collects magazine subscriptions from customers at the time subscriptions are sold. Subscription revenue is recognized over the term of the subscription. Tomorrow collected $20 million in subscription sales during its first year. At December 31st, the average subscription was 1/4 expired. So instead of looking at individual subscriptions, because can you imagine the amount of journalizing that would require? A lot. We tend to do an average subscription expiration, okay? So again, pretty straightforward. And we've got fairly generic account names that we're using for most of these. So when you collect the money in advance, and that's in millions of dollars, it's 20 million, just decided not to use all the zeros, a debit to cash for 20 million, a credit to deferred subscription revenue. Deferred and unearned mean the same thing. Write that down. Deferred. What are you deferring? Deferring recording it as revenue until it's what? Earned. So I tend to use both of these terms, like interchangeably, right? So if I called that unearned subscription revenue, it's the same as deferred subscription revenue. They mean the same thing, okay? Now, 1/4 of 20 is what? 5. So 5 million of the 20 million is going to get recognized as revenue on December 31st. So what does that mean? That means we reduce the liability account because we provided the subscription, the magazine, whatever it is, and we move that amount into a revenue account. So again, deferred subscription revenue gets reduced. If you're keeping T accounts, right? Right, we're left with 15 still here we owe. Makes sense, right? And 5 million of revenue now. Nothing crazy there. Let's take a look at an example for gift cards, and then third party, and then we'll stop. Okay, so gift cards are a pretty common form of advance payment. The restaurant, the retailer, they're going to initially record the cash received as a liability because they owe something to whoever the customer is going to be that you gave the gift card to, right? So there are usually stipulations that go along with gift cards. Some gift cards have expiration dates, some don't. Some gift cards lose a percentage of their balance as time passes, so it just kind of depends, right? As far as redemption, that just means that when the customer comes and presents the card, right? And what usually happens with a gift card? Gift cards, oftentimes people spend more than the face value of the gift card, right? And so you've got a portion of the transaction that is just going to be a reduction of a liability and an increase to revenue, and a portion that might be cash and then another increase to revenue. So it probably gets split up over those two things. What do we mean by on breakage? If the probability of redemption is viewed as remote, in other words, not likely going to be presented with a gift card. I mean, I'm sure some of you have gift cards and maybe you use a portion of it and you get a gift card, maybe you use up to it's $50 and you use $48.20. well, then you're just gonna be like, forget the rest of that, right? Cause what are you buying for $1.80 or whatever it is? All right, let's take a look at an example here. During May, Great Buy sold $2 million of gift cards. Also during May, 1.5 million of gift cards sold in prior periods were redeemed by customers, and $1 million of gift cards sold in prior periods expired and were unused. So it's just free money, right? Free money. Okay, so let's take a look at each of these events. So to record the sale of gift cards, notice again, debit to cash. Your credit is to a liability account. That's what this chapter is all about. Your initial journal entry should always be a credit to some liability in this chapter. So notice we call it deferred gift card revenue, right? We're calling it exactly what it is, just like we called subscription revenue, deferred subscription revenue for $2 million. And then we have a redemption. And we're ignoring inventories and such because we don't, I'm just trying to keep it simple here. We reduce the liability, right, by the amount of gift cards that have been redeemed, and now we call that money revenue, because what's happened is your customer has actually come and presented the gift card, and you have given them something in exchange. And then lastly, gift cards expired, they're just revenue. You reduce the revenue account, you reduce the deferred revenue account because you don't owe it anymore, right? If it's expired, they don't get to use it. That's just free money, revenue gift cards. Again, fairly straightforward, I think. Any questions? Okay, one more example that you guys have had, collections for third parties. We've done sales tax before. That's probably the prime example here. Taxes, think about it. When your employer withholds taxes from your paycheck, what are they doing with those taxes? Sending them off to the appropriate tax authority, right? Don't you just trust that when your paycheck is, however much less than the gross wages, that the employer has withheld certain taxes and they're sending them off to the right tax authority for you? They better be. Not your problem if they're not, but that's the assumption. We just assume that's what happens. That should be what happens, right? So withholding taxes, like for federal income tax, state income tax, Social Security, Medicare, any kind of insurance that you have through your employer, paying a premium, your contributions to retirement plans, those are getting deducted and sent to your retirement account by your plan administrator, which is your employer, and union dues if you're paying union dues. Another example, that's just payroll. Another example is sales tax. If I own a retail store, I am required to act as a collection agent for the Pennsylvania Department of Revenue, or whatever department or whatever state you live in. And I collect the money from the consumer, who's responsible for paying the tax, but I'm responsible for collecting it if I'm the retailer. I can't keep that money. I gotta mail that off to the Department of Revenue periodically, typically once a month. So assume a sales tax rate of 4% and a local of 3%. The total there is 7%. You can combine those. And you'll notice that the debit is for cash is $100 for the sale and another $7 for the taxes, right? And the retailer can record $100 as revenue, but the other $7 is a liability. They are liable or responsible for submitting that to the state. Again, every journal entry should have a credit to some liability account in this chapter. What happens when it's time to remit that? What's the journal entry? Somebody tell me. It's time to pay the $7. What would be the journal entry? I write a check. Yeah, a debit to sales tax payable for 7, a credit to cash for 7. Okay? You don't want to not pay that. What happens with a lot of retailers, and this is more common in smaller businesses where cash flow is an issue. You're collecting cash, right? So let's say that I own a small restaurant maybe, and I'm collecting, cash sales, and there's some sales tax in there, and I'm just depositing it all into my checking account, one checking account, and I'm paying bills out of there. Well, the end of the month comes around, and now I'm required to figure out how much sales tax I collected in the last month, and I gotta write a check to the Department of Revenue and send that off. And sometimes you fail to identify what that amount of cash is in total for the month, and you're like, ooh, that's a big number. I didn't really plan for that, right? Because it just goes into your operating account, it kind of gets lost in there. So when I used to do more bookkeeping stuff for some folks, I always kind of made a little table or a little note so that in that individual's mind, that was not money that they should be spending. Because it can get lost in your cash account, and you're like, gee, I don't have enough money to pay the sales tax, because I used it to pay other bills or whatever. That's pretty common. All right, any questions? Okay, so I'm going to switch over here to brief exercise and have you work on a couple of these. And again, I don't know why I don't bring my highlighter, but I didn't bring my highlighter. So, I am on page 745 still. That hasn't changed. I want you guys to take a look at brief exercise 13.6, 13.7, and 13.8. And I'm going to give you time right now to work on those. Got lots of time. I'm going to walk around and give you guys your exams back while you're doing that. Bless you. Questions while you're working on that? Anybody have questions? We didn't talk about 13.9 yet, so don't do that. No one has any questions? Yes. Where are you at? Oh, a diode. Yeah, that's like it's a board you I'm trying to think. I think that's what my husband called. That's what they call his board. Like, he works for UPS. You know, the board that people sign. That's a diode.
Those diodes I use are these little tiny capacitors.
Google it. I don't know. That's what I thought he called. Yeah, I thought that's what he called his board, as a diode. I could be wrong. Yeah. Well, somebody Google diode. Just out of curiosity now. I'm pretty sure that's what my husband calls his board, the people you sign if you get a UPS delivery. Yeah. I mean, so I mean.
Yeah, I solder these things.
Yeah.
Well, we'll make her look at it.
Yeah.
That's the only reason why I know.
All right. Well, yeah, for us electronically challenged individuals, right? All right. This is not, wait, let me see, is this graded? I don't remember. Yeah, let's make this graded, why not? Oh, you guys don't like points for homework? Yes, you do. Because this will be, obviously the end of the week is, me updating homework, and the more homework you have, the better. There's also a quiz in here that's due Friday, by the way.